All right, today we're cracking open the latest financial report from Zhongxin Fruit and Juice. And, this one's really interesting because it's a perfect example of how a company can look profitable on the surface, but tell a totally different story once you dig in. So, yeah, let's get right into it. And right off the bat, we're looking at a real puzzle. The company actually reported a profit. I mean, that sounds great, right? But if you look a little closer, their sales have completely cratered. So, how on earth does that happen? That's the big question we're going to unravel today. Okay, so here's how we're going to tackle this. First, we'll look at the profit story they're telling. Then, a quick financial health check. After that, we follow the money, the cash flow. And finally, we'll see what's on the horizon for Zhongxin and wrap up with the key takeaways for any investor watching. So first up, the profit story. We're going to start with the company's performance. And for that, you've got to look at the income statement. Think of it like their report card for the last 6 months. It shows us what they sold and, crucially, how much profit they actually made from it all. And whoa, the very first number that just jumps out at you is this one. We're talking about a 43.7% drop in revenue. That's their total sales. And it's compared to the exact same time last year. I mean, that is a huge, huge decline. Yeah, and to put that in actual numbers, sales fell from over 168 million RMB all the way down to just under 95 million. So what happened? Well, the company says it's because of weaker demand. Basically, their customers bought a ton of stuff last year, and this year they just stopped ordering. Okay, but this is where the plot thickens. Even with their sales falling off a cliff, their gross profit margin, that's how much profit they make on every single sale before other expenses, it actually went up. It went from 16.3% to 19.2%. So how in the world did they manage that? Well, according to the report, it came down to a few things. They made some serious tech upgrades on their production lines, which made them way more efficient and helped them cut costs. So long story short, they got a lot better at making their juice for cheaper. That means every bottle they did manage to sell brought in more profit. And here's the actual income statement. We're not going to bore you with every single line item, but if you look all the way at the bottom, there it is, a final profit of 13.5 million RMB. So mystery number one is solved. They stayed profitable by tightening their belts and becoming way more efficient even though their sales tanked. Right, but profit is only one piece of this puzzle. To really understand what's going on, we need to do a financial health check. That means we're shifting from the income statement, which measures performance over time, to the balance sheet. And the balance sheet is more like a snapshot. It shows you exactly what the company owns and what it owes on one specific day. And this chart really tells a story. Remember all that product they were making so efficiently? Well, here's where it ended up. Their inventory, that's all their unsold juice concentrate, it just exploded. It jumped from about 36 million RMB all the way up to almost 100 million. And that's the key takeaway here. They got really good at making juice, but because sales were so slow, all that product just piled up in a warehouse. We're talking about an increase of almost 62 million RMB in unsold goods. And that means a ton of the company's cash is just sitting there, tied up in boxes of juice concentrate. Okay, so now let's flip over to the other side, what the company owes. This chart shows us where their debt is coming from. And you can see, more than half of it is from borrowings, think bank loans. Then, get this, another 31% is money they owe to their own parent company, SDIC Zhonglu Fruit Juice. It's pretty clear they're leaning heavily on debt to keep the business running. And here's a look at the actual balance sheet from the reports. On one side, you have the assets, including that mountain of inventory we just talked about, and on the other, the liabilities. It all adds up, sure, but you can definitely start to see some potential cracks forming. Okay, so let's recap. We've got a company that's profitable on paper, but it's sitting on a ton of unsold product and a lot of debt. This brings us to what I think is the most important financial statement of all, the cash flow statement. This document doesn't care about accounting profits, it just tells us where cold hard cash actually came from and where it went. And it's pretty simple, really. It's broken into three main parts. You've got cash from operating activities. That's money from their main business, making and selling juice. Then there's investing activities, like buying new equipment. And finally, financing activities, which is stuff like taking out loans. And honestly, that first one, operating cash flow, is the one you really want to watch. It tells you if the core business is healthy. And here it is. This might just be the most important number in this entire report. A negative 33.9 million RMB in operating cash flow. And yeah, those parentheses mean it's a negative number.
What this means is that their core day-to-day business was actually losing cash, burning it, not making it.
So why was it negative? Well, it all goes back to what we saw on the balance sheet. A massive amount of cash got tied up in producing all that juice that then just sat in the warehouse. So think about it. The income statement says profit, but the company's actual bank balance went down because of its main business operations. That's a huge red flag. And if you look at the full cash flow statement, the story becomes crystal clear. You can see the cash they burned in their operations was basically replaced by cash they brought in from financing activities. And what's financing? It's the new debt they took on. They were essentially borrowing money to cover the cash being lost by the business itself. All right, so that's the picture of the last 6 months. But what about the future? I mean, where do they go from here? The report also gives us a peek into what management is thinking, the risks they're worried about, and what their game plan is. Yeah, and management is pretty blunt about it. They start their outlook section by saying, and I'm quoting here, the group continues to operate in an uncertain environment. You know, when a company says that, it's basically a big flashing sign for investors to pay very close attention. So what exactly are those uncertainties? Well, they list a whole bunch of them. Things like trade policies and tariffs, rising logistics costs, and just not knowing what market demand will look like. Plus, they're facing tough competition. And because they sell fruit juice, there's always the risk of climate change messing with their apple supply. So how are they planning to deal with all that? Well, their strategy is pretty straightforward. They're basically going to double down on what worked before, focusing on keeping costs low and being as efficient as possible. They also talk about branching out into new markets and products, and of course, leaning on their big parent company for support. All right, we've gone through the income statement, the balance sheet, the cash flow, and their outlook. So let's bring it all together. What are the main things an investor should be thinking about here? Let's break it down. It really is a split story, isn't it? On one hand, the good stuff, the company is still making a profit, their profit margin has actually gotten better, and they're clearly good at controlling costs. Plus, having that big parent company in their corner is a major plus. But then you have the concerns, and they're big ones. The revenue has crashed, they're burning through cash in their main business, they have a mountain of unsold inventory, and they're relying really heavily on debt. It is a very, very mixed bag. And we just have to end with this important disclaimer. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.